Steve, listening to what you were saying and taking it back and looking at how the stock has done over the past 5 years, I think is the right way to approach this because it's all about the revenues, isn't it? It's all about revenue generation. And if you remember last year, exactly 1 year ago, December 2018, Credit Suisse said that they were on track to get to that return on tangible equity target of 10% by the end of 2019, assuming revenue growth of around 6% according to some analysts. If you look at the revenue growth for this year, they've only tracked around 3%, which obviously entailed missing their return on tangible equity loose target for this year, which was 10%. They're tracking around 9.5%. So it's no surprise that that particular target is going to be revised lower. And from what we can see from the investor release today, they're aiming to be somewhat close to 10% and aiming for a pickup next year to the tune of 150 to 175 basis points. So still aiming to lift up that return on tangible equity target, but perhaps not as ambitious as it was before. In previous times, they have said that they want to get that target up to around 12% by end of 2020. But obviously, it is a very difficult operating environment for all banks and not just Credit Suisse. Another element that I want to draw to as well, just two other objectives that they had for 2020, their cost targets. They had a range between 16.4 billion Swiss francs to 17 billion. It looks like they're on track to come to cost savings of around 16.5 billion. So that is proceeding as they've outlined. And the last point is something that you mentioned as well when it comes to share buybacks. And overall for this year, they've implemented about 700 million Swiss francs of share buybacks, 700 million Swiss francs of dividends, totaling around 1.4 billion, again, in line with their objectives. So I would say on the cost-cutting front and on the share buyback front, they're pretty much proceeding as planned. The return on tangible equity target, not so much. Now, I had the opportunity to speak to the CEO, Mr. Thiam, back on their third quarter earnings on October the 30th, and I asked him about whether or not they were going to get to that target by the end of the year. Let's listen to what he told me at the time.
If you look at that return on tangible equity that you're mentioning, we did 10 in Q2 and 9 in Q3. So we are tracking at that level. It's Q1 that was significantly below that, where we had a 4% drop in revenue. And that was exclusively due to external circumstances. Q1, unfortunately, is a very important, if you wish, it's the worst quarter where to lose revenue because the way banking works, Q1 and Q2 are the strong quarters. But 9%, honestly, when I look at results of other banks in this environment, when we started this, the goal was to do okay in bad environments, and that 9%, I think, goes in that category.
So essentially there he's blaming the big miss on the return on tangible equity target on that weak Q1. They only had a return on tangible equity there of 4%. Second quarter, third quarter, north of 9%, which explains why they didn't get to that 10% magic number for this year. But looking at overall at the business, one element that they've been very clear on over the past 5 years, again, going back to that 5-year view that you mentioned, Steve, they've reduced the size of the investment bank dramatically. In 2014, 60% of the overall group revenues came from the investment bank. Today, we're looking like something like 18 to 20%. It's shrunk a lot. And in this environment, certainly it makes sense. Credit Suisse is looking more like a UBS from a revenue perspective than, say, a JP Morgan or a Goldman Sachs. It has significantly shrunk the size of the investment bank. And at the same time, it's also beefed up its wealth management business, and net new money continues to grow quite healthy. So that's a part of the business that they continue to point to from a growth perspective. AUM continues to go in the right direction as well. So I suspect we'll hear more along those lines as the Investor Day continues over the next couple of hours, but we'll keep you posted on other highlights that come out of the meeting. Hi, I'm Joumanna Bercetche, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.